In this video, we will talk about how to mortgage your real estate investments and what to do if a bank says no. Sometimes you gotta get creative. In this video, we'll discuss what is a mortgage, traditional mortgages versus investment mortgages. We'll talk about the process of obtaining a mortgage, why real estate investors have trouble attaining financing, and we'll go over 9 creative mortgage hacks to finance a real estate investment. Navigate the video using the chapters in the timeline below. Let's start with the basics. A mortgage is a loan that is secured by a property. The borrower makes periodic payments to the lender, and the lender records a lien on the property as security for the loan. If the borrower defaults on a loan, the lender can foreclose on the property and sell it to repay the amount owed. When do you need a mortgage? You typically need a mortgage when you want to buy a property, but you don't have the full amount of the purchase price in cash. Mortgages can also be used to finance other aspects of real estate investments as well, such as renovations or repairs on a property. There are 2 types of avenues mortgages can travel: traditional mortgages and investment mortgages. Traditional mortgages are for primary residences, while investment mortgages are for properties that will be used as rental properties or for other commercial purposes. The process of obtaining a traditional mortgage versus an investment mortgage is often similar. The first step in the process is to get pre-qualified for a loan. This can be done by meeting with a lender and providing them with information about your income, debts, and credit history. Based on this information, the lender will be able to give you an estimate on how much they're willing to lend you. Number 2, find a property. Once you have been pre-qualified for a loan, you can start shopping for a property. It's important to remember that you will need to find a property that's within your budget and that meets all of the guidelines set forth by the lender. Number 3, make an offer on the property. The offer can be up to the full amount of the loan that you have been pre-qualified for. Hopefully, if all goes well, the seller will accept your offer and the sale will move forward. Number 4, apply for a mortgage. After the offer has been accepted, then you'll need to begin the application process for the mortgage. The application process will vary depending on the lender, but an appraisal of the property will also be required in order to determine official value to base the loan upon. 5, close the property. This will involve the signing of the purchase agreement and paying any necessary fees. Once the closing is complete, then you will be the official owner of the home or property. Some quick differences between investment and traditional mortgages are that the terms are usually shorter for investment than for traditional sales, and the interest rates are often higher. Additionally, the way your taxes will be handled and deducted will differ as well. So I always advise that you have a tax or financial professional handle such affairs. Do real estate investors have trouble attaining financing? Yes, real estate investors can have trouble obtaining financing for their investment properties for a variety of reasons. Some lenders will see investments as risky. If you are buying through a company or an LLC instead of in your own name, banks know that LLC members can't become personally liable for debts. So in this case, many lenders will only extend a mortgage loan to a small LLC or corporation if the business owner volunteers their own personal assets to back the debt. If one does lend to investors, they may charge higher interest rates and fees and ask for a higher down payment. What are some traditional mortgage options? Number 1, a fixed rate mortgage. A fixed rate mortgage is the most common type of mortgage. The interest rate remains the same for the lifespan of the loan, so the monthly payments will stay the same as well. And this makes it easier to budget for your mortgage payments long term. Number 2, adjustable rate mortgage, or ARM. An adjustable rate mortgage has an interest rate that can change over time. The monthly payment may go up or down as interest rates change. ARMs are most often used by people who expect to move or refinance before the interest rate goes up. Number 3, conventional mortgage. A conventional mortgage is a traditional mortgage that is not backed by the government. Conventional mortgages are available from private lenders, such as banks and credit unions. Number 4, FHA loan. An FHA loan is a mortgage that is insured by the Federal Housing Administration, or the FHA. The FHA does not lend money to borrowers directly. Instead, it insures loans made by private lenders, and this protects the lender from loss if the borrower defaults on the loan. A VA loan. A VA loan is a mortgage that is guaranteed by the Department of Veterans Affairs, the VA. The VA does not lend money to borrowers. Instead, it guarantees loans, again, made by private lenders, similar to how an FHA works. VA loans are only available to veterans, active duty service members, certain reservists, and National Guard members. Can you use a traditional loan to pay for an investment property? Yes, you can use a traditional loan for an investment property. As I said, you may have a higher interest rate and more significant fees. In addition, the lender may require a higher down payment. Investment properties are considered riskier than primary residences, so lenders often charge those higher rates we spoke of to compensate. So, what happens if you finally find that investment property of your dreams and you can't make a traditional loan work? Here are 9 creative mortgage hacks to finance a real estate investment. Number 1, seller financing. When you are buying a property from a seller who is willing to finance the purchase, you can avoid going through the traditional lender. The terms of the loan will be determined by the seller, and they may be more flexible than a bank would be. There are a few things to keep in mind when considering seller financing. First, the seller's financial situation. If the seller is in a good financial position, they may be more likely to offer financing to make a deal happen. However, if the seller is in a difficult financial situation, or say they go bankrupt or they die, it could negatively impact you as the buyer, which sounds terrible because they died, as you have lesser protections than you would in a traditional sale. Something else to consider are your own goals and objectives. Are you looking for a short-term investment or a long-term rental property? What are your repayment terms? Are you willing to take on the risk of a foreclosure? Next, hard money loan. A hard money loan is a specific type of asset-based loan financing through which a borrower receives funds secured by real property. Hard money loans are typically issued by private investors or companies. Interest rates are typically higher than conventional property loans, starting often around 8%, because of the higher risk and shorter duration of the loan. It's usually within the span of about 12 months or less. Who uses hard money loans? Hard money loans are commonly used by real estate investors for fix and flip projects, renovations, and short-term financing. For experienced investors who have a solid track record, hard money loans can be a great option because they are typically easier to qualify for than traditional bank financing. How do hard money loans work? Hard money loans are asset-based loans, which means the loan is secured by the value of the property being purchased. The lender will appraise the property and loan a percentage of the purchase price, usually around 70 to 80%. The borrower then uses the remaining cash to complete the purchase. Once the property is finished and sold, the borrower then repays the loan plus interest and fees. Number 3, cash or financed partnerships. If you have trouble qualifying for a loan on your own, you can sometimes partner with an investor or several investors who have access to cash or they have good credit. 2 or more of you can purchase the property together, and you can share in the profits or losses from the investment. What are these kinds of partnerships? In a cash or financed partnership, 2 or more investors pool their money together to purchase a property. The group then elects one member to act as a managing partner, who is responsible for overseeing the property and making sure that it's well maintained. There are a number of benefits to investing in this kind of situation. First, you have access to capital. You have shared risk as you are sharing the risk with other investors. Another benefit of partnerships is that they offer diversification. By investing in a partnership, you have greater capital. You can spread the risk out amongst different properties, which can therefore help protect you and your portfolio overall. And a final logical question when considering a partnership is where to find them. There are a number of online directories, such as Real Estate Investors Network, that list cash or financed partnerships. Check out places like meetup.com or even Facebook groups of local investors. They set up events, and they can be a great way to meet others in the business and learn about potential opportunities. don't forget to ask your friends, family, and colleagues if they know of any cash or financed partnerships. You never know who might have a great lead on an opportunity. Number 4, crowdfunding. Crowdfunding is a way to raise money with a large group of people. There are many crowdfunding platforms that allow investors to pool their money and invest in real estate projects. Crowdfunding can be a great option for investors who don't have a lot of money to invest up front. One typically creates a profile on a crowdfunding platform and sets a target amount of money that they want to raise. Investors can then see your profile and decide whether or not they want to invest in your project. If you reach your target amount, the money is then transferred to you and you can use it to fund your investment. If you don't reach your target, the money is then returned to investors. Number 5, wraparound mortgage. A wraparound mortgage is a type of financing that can be used to purchase an investment property. This type of mortgage allows the buyer to wrap the remaining balance of their primary mortgage around a new loan for an investment property. The advantage of this type of mortgage is that it can often help to save money on interest payments. It's important to note, however, that wraparound mortgages can also be rather risky. If the investment property is sold or foreclosed upon, the lender could come after the property used as collateral, meaning the borrower's primary residence. For this reason, it's important to speak with a financial advisor or a mortgage professional before taking out a wraparound mortgage. Number 6, personal loan. A personal loan can be a way to finance an investment property. You can use the loan for down payment, closing costs, and other expenses associated with buying an investment property. There are a few things to consider when getting a personal loan for an investment property, though. They will check your credit history, income and employment history, and many other personal things. If you have good credit, you may be able to get a personal loan with a low interest rate. However, if you have less than stellar credit, you may have to pay a higher interest rate or provide collateral for the loan. When you are looking for a personal loan, it's important to compare offers from different lenders. Make sure you understand the terms and conditions of the loan before you agree to it. Number 7, a bridge loan. A bridge loan is a short-term loan that's used to purchase a property before you have the money to do so. Bridge loans are often used by investors because they can be funded quickly and they have flexible terms. However, bridge loans typically have higher interest rates and fees. A bridge loan is a short-term loan used in real estate transactions that bridges the gap between the buyer's down payment and the funds necessary to pay for the property. Bridge loans are popular in today's market because they allow investors to purchase a property without having all of the traditional financing in place. For example, if the buyer is interested in a fix and flip property, they may not have all the money necessary to purchase the property just outright, and so they may seek out a bridge loan to fill in that gap. So how do they work? Bridge loans are typically repaid within a short period of time, usually 6 months to 3 years. The loan is paid back when the property is sold or refinanced. In some cases, the borrower may be required to make interest-only payments during the life of the loan. 401k and 403b. Using a 401k or 403b can be a great way to invest in an income property. In essence, you withdraw from your 401k or 403b and you use that money to purchase a property, to make improvements, or to rent out a property. There are a few reasons why this might not be the best idea. First, when you borrow from your retirement account, you are taking money out of something that's meant to be used for your retirement, and this can put a strain on your future finances. Second, the interest rates on a 401k and 403b are often higher than interest rates would be from a more traditional borrowing situation. This can cost you more money in the long run, and therefore, it might not be the first go-to option on my list to get money for a piece of real estate. Additionally, if you default on the loan for any reason, you will owe taxes on the money that you borrowed, and this can leave you in a very difficult financial situation. Number 9, cash out refinance. Cash out refinance occurs when the borrower refinances their mortgage for more than the amount they owe, and they take the difference in cash. This can be an attractive option for borrowers who have built up equity in their investment property and are looking to take out some of that equity to use for other purposes. There are a few things to keep in mind if you're considering a cash out refinance on your investment property. First, you'll need to have built up equity, as we said, in your property. For example, it is most commonly seen in primary residences. If you've only owned your investment property for a short time, you may not have the equity to play with at this time. 2, you'll need to be sure that you can afford the higher monthly payments that will come with a refinance. When you refinance, you'll be taking out a new mortgage loan that will have its own monthly payment. So be sure that this payment fits into your budget before moving forward. 3, you'll need to factor in the costs of refinancing, which can certainly add up. These costs include things like appraisal fees, title insurance, and loan origination fees. It's also not commonly thought of, but that refinance may trigger your local municipality to reassess your property, and therefore your taxes may raise as well. 4, you'll need to have a good credit score in order to qualify for a refinance in the first place. Lenders will be looking at your credit history and your credit score when considering a loan, so it's important to make sure your credit is in good shape before you apply. You'll also need to be prepared to provide documentation to the lender in order to prove that the investment property is a good investment. This may include things like tax returns, rental agreements, and other financial documents. If you're considering a cash-out refinance on your investment property, make sure to weigh all of the contributing factors before making a decision. This type of refinance can be a great way to access equity in your property, but it's important to understand the pros and cons before moving forward. So there you go. I hope that was helpful. If you're a new investor, check out Mashvisor.com. We help beginner and seasoned investors find and analyze investment properties across the country, and you can get a free trial by using the link in the description below. Have a wonderful day. My name is Michael. Thank you so much for watching, and I will see you next week.